Have you ever wondered why some banks seem to thrive in the most challenging economic times? It's a question that's been boggling minds for years. Yet the answer lies in a fascinating paradox of profitability, a phenomenon that sees some banks not just surviving, but flourishing during economic downturns. Now, let's dive into this intriguing concept. The paradox of profitability isn't a new revelation in the world of finance. It's a reality that's been played out time and time again through recessions, depressions, and even global crises. At its core, the paradox is this. While most industries suffer during periods of economic hardship, some banks seem to buck the trend, their profits swelling even as the financial tide turns against them. This is what we call counter-cyclical profitability. But how does this happen? Well, imagine a ship in a storm. The waves are crashing, the wind is howling, but the captain remains calm, steering the ship safely through the tempest. The banks that thrive in economic downturns are like this captain. They navigate the storm of economic hardship with a steady hand, leveraging their resources and making strategic decisions to not just survive, but thrive. Take the global financial crisis of 2008 as an example. As economies around the world fell into recession, some banks managed to navigate the storm and come out stronger. They did this by leveraging their assets, reducing their risks, and capitalizing on opportunities that emerged from the chaos. It's a testament to the resilience and strategic prowess of these institutions. This phenomenon isn't just confined to major economic downturns. It's a trend that's been observed during periods of mild economic instability too. It's a testament to the unique position banks hold within the economy and the strategic decisions they make to secure their profitability. This brings us to the question, how do banks manage to swim against the economic tide? To answer this, we'll need to delve deeper into the strategies and decisions that allow these banks to turn a crisis into an opportunity. Let's continue this journey in the next scene, where we'll take a closer look at the actions of Morgan Chase and Company during some of the most challenging economic times in recent history. And one of the best examples to illustrate this paradox is the story of Morgan Chase during the 2008 financial crisis. Morgan Chase, under the astute leadership of Jamie Dimon, navigated the turbulent waters of the financial meltdown with a remarkable degree of success. While many of its peers were succumbing to the crisis, Morgan Chase made strategic decisions that set it apart. The bank was able to capitalize on the situation by acquiring struggling competitors at bargain prices. Notable among these acquisitions was Bear Stearns, a one-time giant of Wall Street that had fallen on hard times. The acquisition, brokered in part by the US government, significantly expanded Morgan Chase's investment banking capabilities, setting the stage for future profitability. Another critical decision that contributed to the bank's success was the aggressive de-risking of its portfolio. As early as 2006, Morgan Chase began to reduce its exposure to subprime mortgages and other risky assets. These preemptive measures, though seemingly conservative at the time, proved to be prescient as the crisis unfolded. The bank's risk management practices, too, were a key factor. Under Dimon's leadership, Morgan Chase developed a robust risk management framework that was able to identify and mitigate potential threats. This proactive approach to risk management allowed the bank to weather the storm better than many of its competitors. The success of Morgan Chase during the crisis was not just a matter of good fortune, it was the result of strategic decisions, forward-thinking leadership, and effective risk management. The bank's ability to seize opportunities in the midst of chaos was a testament to its resilience and adaptability. And it wasn't just about surviving the crisis. The strategic decisions made during this period set the stage for a decade of growth and profitability for Morgan Chase, solidifying its position as one of the world's leading financial institutions. Morgan Chase's success story is not an isolated case. There are other banks that have also managed to turn the tides in their favor. Another powerful example is Goldman Sachs during the Eurozone debt crisis. This titan of the financial world faced a turbulent sea of economic uncertainty, but rather than retracting, they innovatively charted a course through the storm. Goldman Sachs, unlike many of its competitors, did not shy away from the debt crisis. Instead, they saw it as a challenge to overcome, an opportunity to demonstrate their financial acumen. Their strategy was twofold. They diversified their risk and introduced innovative product offerings. Let's delve into risk diversification first. Goldman Sachs understood that putting all eggs in one basket was not a wise decision during such precarious times. So they spread their investments across a wide range of sectors and geographies. They invested in emerging markets, technology, healthcare, and other sectors that were less affected by the crisis. They also diversified their portfolio geographically, investing not just in Europe, but also in the Americas and Asia. This approach reduced their exposure to any single sector or region, thereby mitigating potential losses. Now, onto their innovative product offerings. Goldman Sachs displayed a remarkable ability to adapt to the changing market landscape. They recognized that traditional investment products might not be as appealing during a crisis. Hence, they developed and introduced new financial products tailored for such times. For instance, they launched funds that focused on investing in companies with strong balance sheets and low debt levels, which were more likely to weather the financial storm. These strategic moves allowed Goldman Sachs to not only survive the Eurozone debt crisis, but also to continue generating profits. The bank's ability to adapt and innovate amidst adversity is a testament to its robustness and resilience. So what can we learn from Goldman Sachs's strategy? It teaches us that in the face of economic turbulence, innovation and diversification can be powerful tools for survival and growth. It underlines the importance of agile decision-making and adaptability in the financial world. As you can see, these banks have mastered the art of navigating economic turbulence. Now, you might be wondering, what does this mean for us and the global economy? Well, let's dive into that. The profitability of banks in challenging times is a paradox that has far-reaching implications. It speaks to the resilience of these financial giants, sure, but it also influences affordability and global economic stability. When banks like Morgan Chase and Goldman Sachs weather economic storms and come out profitable, it can cause a shift in the affordability landscape. For instance, their strategies might lead to tighter lending criteria, making it more challenging for consumers and businesses to secure loans. Moreover, the profitability of these banks in tough times can act as a safety net for the global economy. It can provide a buffer against financial shocks, promoting stability and confidence in the financial system. So, the next time you hear about a bank making profits in tough times, remember, it's not just about the money, but the decisions, the strategies, and the ripple effects they create worldwide.